Good, bad, or indifferent, if you are not investing in new technology, you are going to be left behind. Good afternoon, ladies and gentlemen. We are Team P. My name is Lada, and my colleagues are Eugene, Alex, Ola, and Roman. And today, we would like to introduce you an ambitious IT market player and convince you that Luxoft is your chance to win. We issue a buy recommendation with 1 year target price of $71.42, representing 28.2% upside. Key reasons for our conclusion are the following. Firstly, effective business model. Secondly, favorable industry growth. Thirdly, strong financial positions. And finally, confirmative valuation results. Now, let's discuss all these drivers in more detail.
Luxoft is an offshore outsourcing IT service provider specializing in software development, application outsourcing, system integration, and IT consulting. The company focuses on deep domain expertise in 4 industry verticals: financial services, automotive, telecom, and healthcare, representing 55, 18, 11, and 4% of revenue, respectively. Also, Luxoft highly benefits from its offshore outsourcing business model. 80% of IT employees are located in Central Eastern Europe.
However, the largest revenue-generating geographies are the US, Western Europe, and the UK, making 36, 31, and 23% of revenue respectively. Moreover, expansive M&A strategy acts as a catalyst for growth and supports the company's leadership positions.
Luxoft operates in a rapidly developing industry. Worldwide IT spending reached $3.4 trillion, with IT services and software forming 19 and 13% of the market respectively. The most significant driver of company's growth over the next 5 years will be digital transformation technologies, such as artificial intelligence, software-defined networking, cloud computing, Internet of Things, and big data that help Luxoft to outperform traditional IT market. While traditional IT spending grows at a CAGR of only 3%, worldwide spending on digital transformation technologies is expected to maintain 17.9% and reach $2.1 trillion by 2023.
Unique combination of industries in which Luxoft operates gives the company an opportunity to maximize the value gained from new technologies. A number of fundamental factors in every single industry will make them grow at a CAGR of 18.9% for automotive, 18.4% for healthcare, 17.9% for financial services, and 16.5% for telecom industry. And now, let us turn to the company's financial health.
Luxoft has multiplied its revenue 2.5 times since the IPO of 2013. The 4-year CAGR is formed by 16% of organic and 10% of M&A growth. Comparing to the industry median value of 12%, we can consider Luxoft to have more confident market positioning. EBITDA has multiplied 2.2 times within this period, with a 14 percentage points higher CAGR than the industry median value. Such a swift revenue growth is supported by 16% EBITDA margin, which is in line with the industry average performance level. Furthermore, company doesn't share its earnings with their equity holders, reinvesting all available income to meet high growth market expectations.
Unlike traditional business models, Luxoft's production engine is intangible. Human capital is the most relevant productivity indicator, which we measured using revenue per employee ratio. During the last 12 months, each company's employee has bought $66.5 thousand for Luxoft. Median market ratio states only $52.7 thousand, which makes Luxoft's employees 26% more productive.
Luxoft has high intrinsic value. We use DCF modeling as the primary method to determine target price and prove it by multiple analysis and Monte Carlo simulation. For the DCF, we applied free cash flow to firm 10-year model with 11.3% WACC and 2% terminal growth rate. Forecasting revenue, we decomposed it by company's main verticals. In each of them, we pointed out the main type of services that Luxoft provides, their dynamics, has formed the basis for our modern assumptions. As a result, we expect that in next 10 years, the revenue will increase threefold with 11.3% CAGR, which is comparable to historical organic growth. Analyzing internal factors of such positive dynamics, we distinguish two main types of clients. Top revenue generators, Deutsche Bank and UBS, which we expect to grow only 3.4%, and high performance accounts, which creates a basis for 14% growth annually. EBITDA margin is expected to be in the range from 16 to 18%, which corresponds to the management targets.
The net working capital projection is based on its component analysis, resulting in 13% of revenue. After cross-checking with peers, we observed Luxoft to be in line. The company generates enough cash to finance their capex, stating 3.7% of revenue, which is higher than the peers' median value. Taking into account all assumptions mentioned before, income approach led us to a target price of $71.42 with a 28.2% upside.
And now, moving to the multiple analysis. Luxoft closest peers were determined by a similar company's market capitalization, their capital structure, geographical revenue concentration, and the lifetime period. Our peer valuation was focused on enterprise value over EBITDA and price to earnings ratio. Our peer analysis states an applied price per share range within $62 to $75 obtained by EV/EBITDA multiple, and the price range starting from $62 to $83 obtained by PE ratio. Luxoft forward-looking EV/EBITDA and PE multiples are 17 and 15% lower than the respective closest peer median values. Therefore, we can consider Luxoft to be undervalued.
To verify the influence of stochastic factors on our model, we applied a Monte Carlo simulation. As key inputs, we have used our blue and gray sky scenario assumption, WACC, based on subjectivity in beta calculation, and inflation rates in the countries where Luxoft operates. We observed a 83.5% probability of a buy outcome.
Analyzing risks, we distributed them into 5 main categories: operational, financial, market, political, and investment risks. Ability to attract and retain top talents and high client concentration may have substantial impact on our forecast. Let us start with staff attraction and retention. Today's IT market is craving for talents. It is experiencing an oversupply of low-skilled specialists, but the number of high-class professionals cannot cover the existing demand. To mitigate the risk, Luxoft has developed an effective system of attraction and retention of staff. This is evidenced in high annual increase in headcount and the low attrition rate.
Furthermore, the company faces a significant degree of client concentration, with 66% of revenue coming from its top 10 clients. Such dependence exposes Luxoft to risk associated with core clients' IT budget challenges. On the other hand, Luxoft's strategy is aimed at the reduction of this concentration by 10 percentage points. Moreover, company's management expects to increase their share of high-performance accounts to 50% by the year 2020 and beyond.
To sum up, Luxoft is a perfect investment opportunity. It has an effective cash-generating business model, enhanced by positive industry dynamics and company's revenue growth potential, which is confirmed by our valuation. Therefore, with an upside of 28.2% and projected share price of $71.42, we are very confident about our buy recommendation. Technologies have created a new value and a thinking approach. The new value is time, and the thinking approach is to succeed. Take your time to succeed with Luxoft. Thank you for your attention. The team is now open for questions.
Okay, thank you very much for your presentation. You mentioned very high growth rate of revenues for the next 10 years, I think. And one of the strongest growth points would be artificial intelligence. But as far as I know, pretty much everyone is trying to do that now, and entry barriers are probably quite low. Why do you think they will outperform or will compete with such strong growth with other peers?
Thank you for the question. First of all, I think the main reason why Luxoft will outperform the traditional market is according to its very favorable business model. Luxoft has quite very effective employees, and they are basically situated in CU region, so where their salaries, their wages are not that high. However, their revenue comes from USA, Western Europe, so they have quite premium segment of clients. Their competitors, such as, for example, Indian companies, they have also very low wages. However, they don't have the same segment of the market. They have quite lower quality of the products that they do. And such business model helps Luxoft to be on the top.
To support Vlada's ideas, according to this slide, the 50% upside is not in terms of Luxoft productivity and products decomposition, is up to the global trends. 50% is in artificial intelligence globally development groups.
I haven't found how you calculated the weighted average cost of capital of 11.3%. Can you please explain that?
Yes, of course. To calculate WACC, we calculate cost of equity and cost of debt. To calculate cost of debt, we use a modified CFA model. To calculate cost of debt, we use the cost of debt for computer technology companies where our Luxoft, our peers companies and competitors are included according to the asset demandaran. As a result, cost of equity result 11.52%, and the cost of debt is 4.05%. As a target structure capital, we use the median of the debt to equity of our peers.
You have this calculation in one of your appendixes, right?
Probably, yes.
Could you please open?
Okay, please don't spend time on that because you have very few time left. So, if you have it, that's it.
Okay.
Thank you.
Yeah, you have such a nice breakdown of the risks for the company. You even mentioned the conflict between Ukraine and Russia. But my question is that the company was founded in Russia, and I think quite a lot of employees are still are based there. So, did you in any way consider the recent scandals with the Russian IT companies like Kaspersky? Do you see any risks of sanctions imposed that could affect Luxoft? Thank you.
Actually, the company can be created in Russia, but now it is headquartered in Switzerland. Zug. About the employees which are located in Ukraine and Russia, this conflict, if it become more dangerous, it may create a serious risk. And to mitigate this risk, the company uses different relocating program concerning during which they relocate employees from Ukraine, Russia, and the nearest CE countries to countries in North America or Latin America. For example, the company has opened new offices and delivery centers in Mexico, in Canada, and there have during the year 2017, the company has relocated 500 employees.
According to the latest information provided during the earnings call of 15th of February, Luxoft has also opened a new delivery center in Bangalore, providing their expansion to the Asia-Pacific region. Also, recently, they had relocated a part of their employees from Ukraine to Poland.
The main reason why we included that risk was that it actually influenced their share price when the conflict between Ukraine and Russia started, and we decided that if something goes wrong, it will also influence our share price. That was the main reason.
Okay, a few simple questions about profitability. You calculated revenues per employees as the highest versus peers. What is the profitability per employee for the company versus peers? And the second one would be your EBITDA chart, which shows the growth and then the gradual decline. Why that? Please explain.
Yes, we have an EBITDA per employee calculation results, which are even higher, even 30% higher than our peers, and basically representing on this slide industry, our competitors.
And as of EBITDA, please show the slide concerned with our free cash flow from model and EBITDA margin. Okay, as you saw on the slide, that our EBITDA margin shows a slight increase. It's due to the situation that now Luxoft invests in its high performance accounts, and it means that it develops its staff to work with such growth companies. But now it hasn't any. He has lower revenue from this. But in the future, when the situation will stabilize, Luxoft will gain from it. And the declining in the EBITDA margin till to the 2028, it's concerned with revenue, with the cost of sales growth. It means that in the future, it will be more expensive to hire new employees and to growth of such and to show such high growth.
What is the key threat from the competition to this company?
We divide our competitors on CE-based and India-based. Our CE-based companies are almost similar to the Luxoft. They deliver their services almost to the same geographies. It is the North America, Europe, and have the equally educated employees, almost with the same experience. And on the other hand, the second group is Indian-based companies. These companies has lower educated employees, and their services are on a one stage lower. And if these companies will be able to increase the educational level of their employees, they can possibly enter our segment of services in terms of the quality of the services and with their quantity of their employees and their sizes, they can really create for us a serious competition.
To support Roman's idea, I want to add that Luxoft operates in IT offshore outsourcing market, which has a relatively lower rate for entering, and we expect a greater amount of peers and competitors. But in Luxoft case, they don't just sell employees hours as outstaffing. They provide end-to-end solution which bring the higher value for their companies and clients.
Just a quick question. In your DCF forecast, I assume you forecast depreciation and capex as a percentage of revenues. Don't you think that would be more logical to forecast it as a percentage of employees or number of offices or something linked to the fixed capital of the company?
We calculated capex really as a percentage of sales because we think it will be more representative in this case. We compare it with our peers and realize that we is even much more higher, and it supports our high growth. We faster change our computer and licenses, and it gives us a reason to be more productive. About the amortization is only as a ratio, but we calculated it uses the remaining value of the tangible and intangible assets, and using the remaining life, average useful life for both groups, tangible and intangible assets.
Time is out.